Welcome back to Smart Stock Sam. And I have to say, if you've been following this channel, right now is one of those moments where everything we called out is playing out almost to the dollar. We told you Microsoft was setting up a critical floor, we told you the smart money would step in, and this past week, the market proved us right in the most precise way possible. But here's what nobody else is talking about. Is Microsoft still worth buying after a privacy nightmare inside Copilot just rattled enterprise clients and a post-earnings crash shook out the retail crowd? Today, we're breaking down next week's exact price targets, a jaw-dropping insider bet that signals where this stock is truly headed, a fresh technical setup, and the one hidden risk that could flip this whole thesis on its head. Stay with me, because what we're about to uncover might surprise even the most seasoned Microsoft bulls. Before we get into the new data, let's talk about what just happened, because the blueprint we laid out last week was validated almost to the penny. We told you the 395 support floor was the line in the sand. We told you institutional money would defend it. And we told you that if you had the patience to hold through the noise, the setup would reward you. That's exactly what happened. The win is the technical confirmation of our support thesis. The risk is a wave of emerging AI headwinds we're going to unpack. And the play has now evolved into a strategic recalibration, a smarter, wider entry zone built for the volatility ahead. But there's one metric buried inside these earnings that quietly changes the entire valuation story, and we'll get to that in just a moment. Now let's look at the actual price action, because the numbers here are almost eerie. From February 17th to the 20th, Microsoft traded with surgical precision inside the zone we predicted. On the 17th, the stock hit an intraday low of $394.53, literally tapping the very edge of our floor before bouncing hard. Every single day last week, buyers stepped in the moment MSFT touched that $395 to $397 range, and the week closed at $397.23. This isn't random noise, folks. This is a structural line in the sand where high-volume institutional buy orders are neutralizing selling pressure in real time. So the next question you have to ask yourself is, who is doing the buying while the rest of the world is panicking? The answer is the smart money. And the evidence is impossible to ignore. While retail investors were hitting the sell button, Soros Fund Management wasn't just holding steady. They increased their Microsoft stake by a staggering 158%. But the signal that really stopped me in my tracks came from inside the company itself. Microsoft Director John W. Stanton personally purchased 5,000 shares at $397.35 per share. That's $1,980,000 of his own personal capital deployed at a very specific price level. When an insider writes that kind of check with their own money, not a stock option, not a bonus, they are not guessing. They are telling the market with conviction that this stock is deeply undervalued right here. Now let's look at the technicals, because the momentum picture is shifting in a way that should have every patient investor paying attention. Just last week, the relative strength index was bottoming out at a bone-chilling 32, deep into oversold territory for a blue-chip giant like Microsoft. Think of it like a spring being coiled as tight as it can go. As of February 20th, that RSI has recovered to 44.84, signaling that the first wave of post-earnings seller exhaustion has very likely peaked. Momentum is rotating back toward the buyers, and that oversold bounce we called is now acting as a confirmed green light for those who are patiently waiting on the sidelines. But here's where it gets interesting, and a little uncomfortable. Because as strong as these technical signals are, we have to be objective. There are three real headwinds that could make this recovery bumpy, and the first one is one that could you ever imagine. A privacy bug so serious it's put IT departments across corporate America on high alert. Microsoft identified a glitch tracked internally as CW1226324. This bug allowed Microsoft 365 Copilot chat to bypass data loss prevention protocols and actually read and summarize emails labeled as confidential from users' sent and draft folders. Imagine your most sensitive, unfinished business strategies being quietly digested by an AI because a security gate was accidentally left wide open. This is the kind of thing that triggers enterprise-level contract delays, and it's fueling a wave of AI skepticism at exactly the wrong time. And if that wasn't enough, Microsoft's own researchers just co-published a study revealing that as AI conversations get longer, what we call multi-turn interactions, the chatbot's reliability drops by 112%. The models start suffering from something called answer bloat, where they begin hallucinating and feeding their own incorrect prior answers back into the conversation as established fact. If Copilot can't stay reliable during a complex work session, the value proposition for those high-dollar enterprise licenses starts to look a whole lot thinner. Could you ever imagine Microsoft's own research team being the ones to expose this? That's the kind of friction that slows adoption cycles, and adoption is where the real revenue growth lives. There's also a third headwind building on the governance side. Leaked documents revealed that ICE, Immigration and Customs Enforcement, more than tripled its data storage on Azure during a period of intensified deportation operations. This has triggered internal employee protests and ethics reports inside Microsoft. For institutional funds with strict ESG, environmental, social, and governance mandates, this kind of controversy creates forced selling pressure completely independent of how good the fundamentals look. It's not about politics, it's about fiduciary obligation, and it's a real variable in the equation right now. So, with all of that in mind, what does the ceiling actually look like? Here's where we stand technically. There is currently a cluster of strong sell signals across the 5-day through the 200-day moving averages. The 50-day moving average, sitting at $400.68, is acting as a heavy ceiling on any near-term rally. Until Microsoft can reclaim that $400 level and hold it with conviction, every bounce is likely to attract sellers looking to exit at better prices. And making things even more interesting, there are nearly 14,000 call contracts sitting right at the $400 strike for the upcoming expiration. This is the battleground. Market makers have a massive incentive to keep the stock pinned near that level to let those contracts expire worthless through time decay. We are in a genuine tug-of-war between bulls pushing for a breakout and market makers defending that ceiling. The question is, will the bulls win? Here's what gives me confidence they eventually will. The put-to-call ratio is sitting at 0.52. That is extremely bullish. For every single person betting on a crash, there are nearly 2 people betting on a recovery. And short interest? A tiny 0.79% of the float. Bears have almost no appetite to short Microsoft at these levels, and that tells you the path of least resistance is ultimately higher, even if the short-term road has some turbulence. Before I give you my analysis on next week's trade setup, a quick but important reminder: everything discussed on Smart Stock SAM is for informational and educational purposes only. Nothing here constitutes personalized financial advice, and past performance is never a guarantee of future results. Always do your own due diligence and consult a licensed financial advisor before making any investment decisions. Markets carry real risk, and you should only invest what you can afford to lose. So here's the recalibrated trade setup. The strategy is to accumulate. We are widening our entry zone slightly to $392.50, all the way up to $397.50 to account for the AI-related volatility we're navigating. Your immediate support to watch is $396.16, but you need a hard stop loss at $392 even. Why so firm on that level? Because if that floor breaks, there is a gap risk that could take this stock all the way down to $345. And that is not a place you want to find yourself without a plan. First profit target remains in the $405 to $410 range as we test that 50-day moving average. And before you get too shaken by the noise, let's zoom out and look at what this company actually is. Microsoft is sitting on $625 billion in remaining performance obligations. That is contracted, locked-in future revenue that is guaranteed to hit the books. Pair that with a gross margin of 68.59%, and what you're really looking at is temporary volatility layered on top of a generational business. The AI bugs will get patched. The ESG headlines will cycle through, but that revenue backlog doesn't lie. So here is the final verdict. We are maintaining a strong buy rating on Microsoft, but with one major caveat. This is a valuation reset that needs time to digest the Copilot privacy bug and the AI reliability concerns hitting the headlines. Expect the stock to remain range-bound between $395 and $405 for the next few weeks. Stick to your strategic entry zones. Do not chase the green candles. And remember, while the crowd is reacting to the latest headline, the insiders and the institutional money are using this consolidation to quietly build their next major position. Volatility is your friend if you know exactly where the floor is. And now you do. If this breakdown gave you clarity, do me a favor and drop a comment below. I want to hear whether you're accumulating here or waiting for a deeper entry. Hit that like button if you found value in today's analysis. And if you haven't subscribed to Smart Stock Sam yet, now is the time, because calls like this one are exactly what this channel is built for. I'll see you in the next one.